proving that implied volatility mean reverts. A fun little segment the team put together, proving that implied volatility mean reverts. At tastylive, we talk about implied volatility and its tendencies to mean revert. All that really means is that when implied volatility goes up, it will come back down, and when implied volatility goes down, it will come back up. At some point. Okay, that's correct. It. This is why we prefer to use premium selling strategies that can make money on this principle. We can prove quantitatively that the mean reverting nature of volatility holds in the short term. Can we prove that? And after a streak of up or down days in the VIX, is there a clear mean reverting bias going forward? It's hard for anybody to say. So after a streak of up or down days in the VIX, is there a clear mean reverting bias going forward? What do you think, Mr. Batista?
I can't believe that there's a clear time frame, 48 hours, 72 hours.
Do you believe we can quantitatively prove that mean reverting holds true in the short term?
Mean reverting in the short term. I don't know what your definition of short term is.
Let's go to the next slide, Beth. So we looked at the VIX and we did 23 years worth of research. We recorded the probability of an up or down day on any random day. We recorded then the probability of an up or down day after a streak of 2, 3, 4, or 5 up days. And again, this is volatility. This is not
price of the
This
market.
is not price. So this is volatility. Let's go to the next slide. On any random day since 2000, the probability of a down day in the VIX, this is in volatility, was higher than an up day, meaning that volatility contracts more than it expands. However, the magnitude of down days are smaller than up days, and there is no long-term positive or negative drift in the VIX. That I think we all knew. So in the VIX, the probability of an up day in volatility is 46%. The probability of a down day is 54% on any random day, which is exactly the inverse of price.
Of the market. Market has
market price. So on any random day, the market has about a 54% chance of being up and a 46% chance of being down. In volatility, it's exactly the opposite. The probability of an up day in volatility about 46%, the probability of down day 54%. It's just inverse of price. But the average magnitude of the move, if we're looking at volatility, it's about 5% to the upside when it moves up, and it's about 4% to the downside. Now, just so we're clear, a 4% downside move is, let's call it 50 cents.
Okay.
Okay? So it's not like we're not talking about some massive number, that's all. Let's go next slide. Okay, here's where it gets interesting. After the VIX had a streak of down days, the probability to see an up day was higher, but only slightly. After 3 down days, the probability of the next day being up or down was exactly 50%. So, so you're right. You could not, exactly what you said. Could you draw a conclusion about what's going to happen after a streak of up days or down days? And the simple answer here is, unless you think you can squeeze something out of the difference between 52 and 48 or 50-50 or 48 and 52, the answer is no, you cannot.
Yeah, you got to go play someplace else. You're not going to find any edge in trading here.
Yeah, the edge is not. The important takeaway from this slide is the edge is not in knowing what's going to happen next. This is so important because this goes to my argument yesterday on our debate about fundamental analysis, and the value of it. I don't care how much research you do and how fundamentally strong you think you are based on whatever it is you look at. The reality is that whether tomorrow is going to be up or down day in volatility is completely random. It's 50-50, basically, just like price. Because if you believe this with implied volatility, obviously price is inverse of this. Price and volatility are both just completely random, up or down. The magnitude can be a little bit greater in volatility, when it goes up, but it's just a little bit, the randomness of the numbers. I mean, there are the numbers. That's 23 years worth of research. Let's go to the next slide. So the streaks of up days in the VIX tell a little bit different story. Now this means, when VIX is up, that means the market's getting hit. So after a streak of up days, the probability of another up day could drop as low as 38%, making the case that mean reversion in the S&P 500 exists, but only after it goes up. So volatility has three states. It can go up, it can go down, it can stay in a lull state. So it can expand, that's going up. It can contract, that's going down, or it can stay in a lull state. Volatility spends 90% of its life going down or in a lull state.
Yep.
That's why when volatility goes up, it has this mean reverting characteristic to it where it pulls back down. So here's some really interesting numbers. The probability of a down day in the VIX after one up day, 56%, after two up days, 59%, 60%, 58%. So basically, the odds swing from 50-50.
As you would expect.
As you would expect. But sometimes it's fun to look at the numbers.
Sure.
Takeaways. Unlike other assets, S&P volatility does exhibit tendencies of mean reversion following volatility expansion only. After a long streak of up days in the VIX, the probability of another up day was only 38% compared to 46% on a randomly chosen day. After streaks of down days, the probability did exhibit slight mean reversion, but not justifiable to buy volatility when it's cheap. So what this means is when volatility gets expensive, we sell it. When it gets cheap, we keep doing the same things we always do.
We're going to take a quick 90-second break and come back. We got more Tasty Live after this. No joy. Your friend and mine, Mr. Scott Sheridan, Tasty Trade World Headquarters.